Lady yields. The gentleman from South Carolina, Mr. Timmons, is now recognized.
Thank you, Mr. Chairman. I think it's important to highlight how we got here and why these hearings on ESG are necessary. Woke ideology used to be an abstract idea on northeastern liberal arts campuses, but now it's top of mind and it has seeped into many of our government institutions and almost every corner of our society. The Biden administration's woke policies have become their top priorities, committing billions of dollars to climate justice and tree equity. And now corporations feel beholden to the woke mob. Just ask Bud Light what happens when you give in to the loudest voices. As the saying goes, go woke, go broke. Their recent campaign has resulted in a 28% drop in sales, relegating their status as the #1 beer in America for nearly 2 decades, down to #2, and it's in a free fall. Costco just removed them from their sales. Perhaps the silent majority isn't so silent, at least regarding spending their hard-earned money. Continuing on our committee's theme of ESG this month, today's hearing is about how woke ideology foot soldiers now staff our bank regulators and how the Biden administration is using these foot soldiers to push our financial institutions into promoting woke climate policies. When it comes to woke policies, what this administration can't legislate, they will regulate. Mr. Gibson, does the Fed believe that it should follow the lead of the European Central Bank in tying monetary policy, collateral policies, and asset purchase policies to consideration of climate change to help promote green financing and channeling of credit from some sectors to others?
So those aren't things that the Federal Reserve has been doing, no.
Do you think it's something that should happen or that could happen?
So my area is supervision. You're asking questions about monetary policy, so I don't have any knowledge that that's something that the Federal Reserve is doing.
Well, it's not going well for Europe. I hope we don't start it here. By its own admission, the Fed could not even effectively monitor and help banks manage interest rate risks. Why should we be comfortable with the Fed putting forward the idea that it can now monitor and help banks manage climate-related financial risks that, again, by its own admission, the Fed identifies are not fully understood, measured, or modeled? Mr. Gibson, do you agree that it should focus on its main mission and not go into these other areas?
So with respect to supervision, our mission is to ensure that banks operate in a safe and sound manner and manage all their material risks, including climate-related financial risks.
Federal Reserve Chairman Powell has said that the Fed has narrow but important responsibilities to use the oversight of banks to ensure they manage the balance sheet risk created by climate change. For each of you, does your agency also believe that they have only narrow responsibilities to provide oversight of banks to ensure they manage risks and nothing more? Mr. Gibson, I know where the Fed is. Mr. Coleman, I'll start with you.
At the UCC, our mandate is to ensure the safety and soundness of the institutions we supervise and ensure that they are managing all of those risks, including any emerging risks, that is very consistent with the frameworks that we have laid out, including our heightened standards expectations. And the banks have identified, and we've identified, that climate risk and climate-related financial risk is an emerging risk to the institutions.
Do you believe that that's a narrow responsibility, or do you think that that is broad? Do you think it should supersede fiduciary obligations to their customers and to their shareholders?
We are not in the business of telling banks who they can or cannot bank. Our focus is on the safety and soundness of the institutions we supervise.
I wish the Biden administration would agree with you. Ms. Aberle, what are your thoughts?
My thoughts are consistent with my colleagues. Our focus is on the safety and soundness of financial institutions and how they manage the risks that are presented in the areas where they're operating and the customers that they're serving.
And you would agree that a return on a shareholder's investment is the fiduciary obligation of whatever entity we're referencing, and that should be first and foremost.
That's not within our area of responsibility. We're focused on safety and soundness.
Mr. Rendell, what are your thoughts?
The NCUA is focused on the safety and soundness of federally insured credit unions and the National Credit Union Share Insurance Fund.
Thank you. Mr. Chairman, I yield back.
The gentleman yields back. The gentleman from Tennessee, Mr. Ogles, is now recognized.
Thank you, Mr. Chairman, and to the panelists. We're almost there. Well, we appreciate you being here. Dr. Gibson, The Fed has considered the notion of double materiality in micro and macro prudential supervision. The idea is that supervisory authority should consider both the risk that the banks face from climate change, such as more losses if there are more floods, but also the impact of actions by the banks on climate change, such as making loans to some where the activity of the borrower allegedly makes climate change worse. For example, if a bank provides loans to certain sectors deemed to be high greenhouse gas emitters, then supervisors should take that into account and consider actions to channel credit and other financial services toward greener activities. My question, will the Fed be introducing double materiality into its supervisory framework? And if so, how should or how will double materiality be defined?
Our perspective is single materiality, not double materiality.
And so have there been instances where green global warming type of factors have channeled credit away from a business sector and towards others?
So it's not the Federal Reserve's policy to discourage banking organizations from dealing with any law-abiding business, so banks make their own decisions about which customers to deal with.
What about guidance from the Fed? Is there any guidance that would suggest that that's something on the horizon or could be on the horizon?
So we have guidance around safety and soundness and making sure that banks are managing all their material risks. And we have proposed guidance on climate-related financial risks.
But, think about the wildfires in Canada. And, obviously there's some that would point to global warming as the cause. But then when you look at the news reports, they're not confident that, some of the fires may have been caused by lightning, but some of it may have been arson, some of it may have been accidental. And so my concern is when we're kind of lumping into and defining global warming and other kind of ESG climate type of jargon, that we're ignoring the fact that lightning has been occurring for a while and that wildfires have been occurring for a while, and that in areas where we're seeing some of the kind of devastation, we're building in areas that are already high risk, right? And so it's not that the climate has changed. Moreover, it's this that perhaps we're not managing the fire or the forest appropriately. And so I caution all of the agencies, respectively, to not try to wordsmith or try to achieve an outcome based off of, quite frankly, natural phenomena that have been occurring. The Fed is asking financial institutions to prepare for the possible future climate scenarios where there could be growing financial risk related to climate change. Would you agree a more relevant, recent, and visible risk would be delayed payments from the Treasury securities arising from a cyber attack or other adversities? It would be easy to set up a scenario to analyze where there are, for whatever reasons, delayed payments as a potential risk to the financial sector. Has the Federal Reserve Board asked financial institutions to perform such scenarios?
Scenarios around delayed payments?
Sure. Say there's some sort of cyber attack, some sort of, what other scenarios might you give guidance that you would want to see in addition to climate risks?
So we expect banks to be managing all their material risks, including cyber risk. We are doing a pilot climate scenario analysis focused specifically on climate-related financial risks, but we're also doing work in other areas like cyber risk to ensure that banks are managing those risks too.
Yes, sir. Now, I guess, one of my concerns that I've had with, quite frankly, many of the alphabet agencies, but, is as we've seen under this administration, an agenda that's permeated the business community. It's been forced upon them. And I would argue that the Fed has been culpable in that agenda. And Mr. Chairman, I'm out of time, but I want to thank the panelists for being here. We are almost done. And again, Mr. Chairman, I yield back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman, is recognized.
Thank you, Mr. Chairman. I want to thank each of the panelists. let me mention, I know forest fires have come up. Ms. Bellatar, you'd mentioned that. I think one of my colleagues mentioned the problem we have with forest fires, particularly in California. If you talk to any of the forest management team, you know what they say the number one cause outside of lightning and outside of intentionally setting fires, the number one cause is?
I speak daily, and they do say it's arson.
Okay, arson, but what's another?
Well, for our fires, we do lightning, arson, and that's been, the primary causes of fires. And for us, it's growing significantly due to not addressing deforestation issues and not actually doing mitigation control to help stop fires from expanding in our communities.
The number one issue that and we have a lot of natural areas and federal lands in South Carolina, but they mentioned the activists, the thatch is 2 and 3 feet that they will not let you take up, which is a tinderbox for an arsonist. My question at one of the hearings was, do you believe trees have lives? In other words, they're beginning and ending, because the activists I talk with will not let you thin the forest to let the sunlight in, let the air. They just don't believe in that. And for the regulators to cap insurance companies because they can't insure it is ludicrous. How would y'all are in the regulatory industry, how would y'all rank if you had to advise your banks on the risk? Where would climate change rank with Mr. Ogles mentioned cybersecurity, defaults? How would you rank climate change as a risk to the bank?
Thank you for that question. We don't specifically rank the risks, but as noted in our semi-annual risk perspective, we do highlight what we believe to be the most significant risks facing the institutions today. We highlighted 4 of those risks, including operational, compliance, credit, and liquidity. And within those risks, we highlighted specific things that could impact those risks.
But how would you, if you had to just say, your safety and soundness is your goal to monitor, how would you, when you gave them a synopsis of all the risks the banks face, where would climate change rank, in your opinion?
I believe that is dependent upon the institution, and it is up to the institution to define how climate-related financial risk could impact their financial stability.
Okay, so you give you have no opinion on should they put that top priority, or is a cyber attack, is a liquidity default, is that doesn't come into play when you advise a bank on what could get them out of the safety and soundness realm? Because I will tell you, according to a Pew Research Center polling this year, climate change ranks 17th out of 21st on national issues with the average public. When you hear some of the ludicrous things that are being said, Al Gore saying that the ocean is boiling. He worked himself into a frenzy. I will tell you that what's bizarre now in this country is you got an administration that is best friends and cozying up to a China which is, I think, building coal plants every week. The CO2 emissions there aren't too good. The issues there, it baffles me that why they're pushing this so much. Secondly, I will say one of the things the Financial Services Committee, and I've talked to the chairman, I think need to do is break down the dollars that are spent. Who is that going to affect? If you can affect a flood, if man can affect the wind, if man can affect a hurricane, where are these dollars? Break it on down, like I do when I have to have a real estate project. Where is this money going? Would that help y'all in evaluating risk to see what your return on your investment is? Okay, I think I get blank stares, but I think that would give you some idea when you find out who's doing what, when you find out where the money's going. I think it'll tell you a whole lot. And for these who think put this risk above everything, not only is it disservice to the shareholders, it's disservice to this country. I yield back.
Gentleman yields. Gentlewoman from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman Barr. I represent a district in Southern California that is very prone to wildfires because of the bad land management policies from Sacramento, droughts, and the impact of climate change. And so I share the concern of climate change, and I welcome opportunities to work together without raising costs for American firms and punishing small businesses with onerous climate disclosure requirements. And we understand the Fed is now undertaking the climate scenario analysis exercise involving a mandate to 6 banks supervised by the Fed. So is the Fed thinking about expanding the pilot program beyond the 6 banks?
So the pilot climate scenario analysis that we're doing this year only includes the 6 banks, and it'll be finished around the end of the year, and then it'll be concluded.
Yeah. You know, so Vice Chair Barr has indicated the findings of the climate scenario analysis will be made public through a report. So does the Fed have plans to incorporate some of what you're learning from the climate scenario analysis into the mandatory stress test using climate risk modeling?
So the supervisory stress test that we do that feeds into banks' capital requirements is separate and distinct from the pilot climate scenario analysis exercise. So those are different things, and they don't feed into each other.
So I want to reiterate that we should be careful to not venture out into additional mandates without first ensuring that our field supervisors are taking care of the bread and butter issue like interest and operational risk. Silicon Valley Bank's failure is a clear case study of the negative outcomes because of the lack of focus on the supervisory framework. Mr. Gibson, how involved were you and other Fed staff in conducting this holistic view or holistic review of the capital with Vice Chair Barr?
So a number of the Fed staff worked on projects and briefings for Vice Chair Barr as he was conducting his holistic capital review.
Sure.
Many of us.
When the holistic review was first announced in 2022, it seemed that this review would be conducted by, Fed board. But given the speech from last week, it seems to only be reflective of Vice Chair Barr's view. So that's why I wanted to know how involved was the rest of the board in undertaking that review, and do you foresee including climate risk as part of the holistic review process?
So the holistic capital review was Vice Chair Barr's review, and it doesn't include the pilot climate scenario analysis that we're talking about here today.
Mr. Jones, let me move on to talk about some other issue. The National Credit Union Association's request for comment on climate-related financial risk based on recommendations made by the Financial Stability Oversight Council or any interagency climate working group that the NCUA participates in, that is led by Treasury or another executive branch agency. Is that right?
So the NCUA board did issue a request for information in April of this year.
The NCUA's request for comment on climate-related financial risk asked whether the NCUA should modify its examination procedures and supervisory posture in relation to the risk, including modifying CAMEL's ratings. So could you explain what modifications to CAMEL's ratings the NCUA has in mind, and if it wants to modify its supervision and examination procedures to promote environmental regulations?
So the NCUA board has not spoken to any changes. We asked about 38 questions in the request for information in order to solicit stakeholder feedback on their perspective and what opportunities may exist for credit unions, but there was nothing particular in mind that's been developed. It's really to solicit feedback openly.
Okay. You are continuing to have the conversation, and did you ask, a follow-up question?
So there were a variety of questions that were posed really to try to better understand the physical risks and transition risks along with the business opportunities. The comment period closed on the 26th of June. We've got 44 respondents and we have staff who are going through that right now.
Thank you. I yield back.
Gentlelady yields, and I'd like to thank our witnesses for their testimony today. It's been very informative, and the testimony we've heard certainly, I'm sorry to say, perpetuates concerns that regulators focus on climate-related financial risk will, in fact, politicize credit allocation assurances notwithstanding. And Dr. Gibson, your testimony is very professionally delivered, and I appreciate your service. But if climate scenario analysis is distinct from the capital framework, why are we doing it? We want to know where this is going, and your assurances that your increased focus on climate-related financial risk will not discourage lending by banks to legal businesses certainly looks like to us, some of us, a distinction without a difference. Because when a regulator comes in and says, we're really focused on climate-related financial risk, that sends a message. Don't lend to carbon-intensive industries. That's what we're concerned about. And to the extent it's not happening now, where is this going? And we're going to continue to ask these questions going forward, and we urge you to heed the admonishment of the Chairman of the Federal Reserve. We need to stick to our knitting. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.